Dive into the fascinating world of finance as we unravel the mystery of assets and liabilities. These aren't just financial buzzwords, they're key players in your journey towards wealth building. So, buckle up and stay tuned as we dissect these two financial terms in the next few minutes. First off, let's shine a light on assets. Now, in the world of finance, an asset isn't a compliment on your personality, though being called an asset sure sounds flattering. No, an asset here refers to something that you own, something that has value. Let's say you've got some cash, that's an asset. Or perhaps you've invested in stocks, bonds, or mutual funds. Those are assets too, even your house, your car, and your grandma's antique vase, all assets. Each of these assets holds value. But not all assets are created equal. Some are liquid assets like your cash or investments, which can be quickly converted into cash if the need arises. Others are non-liquid assets like real estate and personal property. These might take a bit longer to convert into cash, but they're still valuable. Assets also differ in terms of their appreciation or depreciation over time. An appreciating asset like real estate or certain investments generally increases in value. Depreciating assets, on the other hand, lose value over time. That fancy car you bought? It starts to depreciate the moment you drive it off the lot. Now, why are assets so important? Well, they play a crucial role in enhancing your financial position. Your assets are essentially your financial lifelines. They're your resources, your safety nets, your tickets to financial freedom. A healthy portfolio of assets can provide you with income, act as a buffer against financial shocks, and even help you secure loans or credit. But remember, building assets isn't just about amassing wealth, it's about creating financial stability and security. It's about ensuring that you have the resources you need when you need them. So, in a nutshell, assets are resources that add value to your financial portfolio. They're not just about the here and now, but about securing a financially stable future. From cash to real estate, assets come in various forms, each with their own set of benefits. So the next time you hear the term asset, think beyond the compliment. Think of the power it holds in your financial journey. Now that we've got a handle on assets, let's flip the coin and look at liabilities. In the simplest terms, liabilities are the exact opposite of assets. They represent what you owe. It's like a financial IOU. A liability is an obligation you have to another party, a claim they have on your assets. The more liabilities you have, the less of your assets you truly own. Liabilities come in various shapes and sizes. They can be as small as a credit card bill or as large as a mortgage on your home. Let's break it down a bit. Loans, for example, are a common type of liability. When you borrow money from a bank or a friend, that's a loan you need to repay. That repayment becomes a liability. Mortgages, another type of liability, are loans specifically for buying property. When you take out a mortgage to buy a house, the house is an asset, but the mortgage is a liability until it's paid off. Credit card debt is another form of liability. When you use a credit card, you're essentially borrowing money from the card issuer with the promise to pay it back. If you don't pay off your credit card balance each month, the debt can grow, making it a significant liability. Even things like bills and taxes can be considered liabilities. If you use electricity in your home, you have a liability to the power company. If you earn income, you have a tax liability to the government. Liabilities play a crucial role in determining one's financial position. If your liabilities outweigh your assets, you're in a negative financial situation. Conversely, if your assets outweigh your liabilities, you're in a positive financial situation. So, why do we need to understand liabilities? Well, they have a direct impact on your wealth. The more liabilities you have, the less wealth you retain. To sum it up, liabilities are obligations that can potentially drain your financial resources. Understanding liabilities, along with assets, is fundamental to managing your finances and building wealth. So, the next time you're about to swipe that credit card or sign that loan agreement, remember you're adding another liability to your balance sheet. Scene script. Understanding the tug-of-war between assets and liabilities is crucial to your financial health. Now that we've defined assets and liabilities, let's delve into how they interact within a personal or business financial setting. You might be wondering, why does it matter how they interact? Well, the interplay between assets and liabilities is what shapes your financial reality. Think of your financial situation as a seesaw. On one side, you have your assets, the things you own that can provide future economic benefits. On the other side, you have your liabilities, the debts and obligations that you need to pay off. For this seesaw to balance, the value of your assets needs to equal the value of your liabilities. But let's face it, having a perfectly balanced seesaw isn't usually the goal in finance. Instead, the aim is to have your assets outweigh your liabilities. This means that the seesaw is tipped in your favor, and you're in a financially secure position. The more your assets outweigh your liabilities, the more financial freedom you have. However, the seesaw can also tip the other way. If your liabilities outweigh your assets, you're in financial trouble. This is often referred to as being in the red. In this situation, you may need to sell off assets or take on more liabilities to balance the scales. Now, how do you tip the seesaw in your favor? It's all about maximizing assets and minimizing liabilities. This might mean investing in things that grow in value over time, like real estate or stocks, or reducing your liabilities by paying off debt or avoiding unnecessary expenses. Keep in mind, though, that not all assets and liabilities are created equal. Some assets might be more valuable or provide more income than others. Similarly, some liabilities might be more costly or risky than others. So it's not just about having more assets than liabilities, but having the right kind of assets and the right kind of liabilities. Remember, the goal is to maximize assets while minimizing liabilities. Now let's pinpoint the key differences between assets and liabilities. Firstly, let's consider their impact on your financial health. Assets are like the good cholesterol in your body. They boost your financial health. They can generate income, increase your net worth, and provide a safety net for unforeseen circumstances. On the other hand, liabilities are the bad cholesterol. They can strain your financial health. They decrease your net worth and can potentially lead to financial stress if they pile up. Now, let's talk about financial planning. Assets and liabilities play contrasting roles here. When you're planning your finances, you aim to increase your assets. You might invest in real estate, stocks, or bonds, or perhaps start a side hustle to build up your assets. But with liabilities, your goal is to manage and reduce them. You might strategize to pay off your mortgage or student loans faster, or avoid high-interest debt like credit cards. Finally, let's delve into their influence on wealth creation. Assets are essentially the building blocks of wealth. They can appreciate in value over time, like a house or an investment portfolio, or generate steady income, like a rental property or dividends from stocks. The more assets you have, the more potential you have to build wealth. Liabilities, however, can obstruct your path to wealth creation. High-interest debt can eat into your income, and large liabilities can prevent you from investing in assets. But remember, not all liabilities are bad. A mortgage, for instance, is a liability, but it also means you're investing in an asset, your home. And while credit card debt is generally frowned upon, using a credit card responsibly can help you build a good credit score. So it's all about balance and smart management. So, while assets can be your financial superheroes, liabilities might play the villain if not managed properly. Let's take a step back and look at the big picture. We've journeyed through the financial landscape, exploring the definitions and roles of assets and liabilities. Assets, like a treasure chest full of gold, are resources that we own or control that are expected to produce economic benefits. These benefits could be in the form of income, like rent from a property, or an increase in value, like a stock that skyrockets. Assets come in various shapes and sizes, from cash in the bank to a patent on a brilliant invention. On the other side of the coin, or should we say balance sheet, we have liabilities. These are the financial obligations that we need to settle. Think of them like those pesky mosquitoes that keep buzzing around waiting to take a bite out of your wallet. Liabilities can be anything from a mortgage on your house to a credit card bill that's due. One might be tempted to view assets as the heroes and liabilities as the villains in our financial story. But remember, it's all about balance. Assets and liabilities are two sides of the same coin, each playing a vital role in our financial health. Just like a balanced diet is key to physical health, balancing assets and liabilities is crucial for financial health. Too many liabilities can lead to financial stress, while an abundance of assets can lead to wealth creation. The trick is to increase assets while managing liabilities. And that, dear listeners, is the essence of financial wisdom. It's not just about making money, but about managing and growing it effectively. Remember, understanding assets and liabilities is your first step towards building wealth. Subscribe to our channel for more financial wisdom.